I'm Lohit Mannan, represents investment business in Bajaj Markets. Let me brief you about my Bajaj Markets for about 30 seconds, then we'll take it around the discussion ahead. Bajaj Markets is a subsidiary of Bajaj Finserv, and it's the fastest growing, fintechs in India, as in one, and also provide one-stop digital marketplace, for all the financial and lifestyle products. Bajaj Markets is has been has now also become a tech fin, by leveraging customer insights, data analytics, and also the technology what we opt for. So to create insure tech, invest tech, credit tech, and e-com tech platforms to the marketplace. And in fact, we are these marketplace platforms has been created to provide it to B2B customers and to the partners. So that's what about the Bajaj Markets. In investment business in Bajaj Markets, we today talk about and distribute saving products as well as investment products. So as far as saving products are concerned, we distribute fixed deposits we are partnered with Bajaj Finance, Mahindra and Mahindra, PNB Housing. And on the investment side, we distribute and offer mutual funds, which are direct mutual funds. Those have been offered with a 0% commission to the customers, which is available on our app, on Bajaj Market app, which customer can be opt for, can complete the onboarding, and can take ahead the transactions to go ahead with. So that's about about Bajaj Markets and investment business. So I head the investment business with Bajaj Markets. Been with the liability business now about for 22 years, and earlier stint with Bajaj Finance, and prior to that with Kotak Mahindra Bank, ICICI Bank, all into liabilities. So now I would request Nirbhay to introduce and to request to take it ahead the presentation forward. We'll be talking about the topic is for discussion today is achieving your financial goals through mutual funds. So that's a basic one what we thought about to start with our investors to understand, wherein Nirbhay is going to discuss, and probably once he is completed his presentation, we'll be able to also have a question and answer session before we conclude the meeting. So session. So over to you, Nirbhay, and you may request to introduce yourself, and then probably take it ahead on that.
Sure. Thanks a ton, Lohit. Thanks for that introduction. I think it was nice to hear or get a brief of what Bajaj Markets also does. I think from my point of view also. So just to give the audience a perspective about about what I do. So I work with Axis Mutual Fund. I'm a part of the investment and product team. So our job is here to come out with innovative products which ultimately serve the purpose that investors can leverage from in terms of deciding where to put their money. I have a total of about 11 years work experience in the mutual fund industry, mostly with in the product function, and I also have some strategy related experience with the CEO's office. I joined Axis about 3 years ago, and before that, I've been associated with firms like Inam Asset Management, which is the largest PMS provider in the country. And also prior to that, I've worked with Birla Sun Life Mutual Fund, where I started off my career. So that's a brief about myself. And like Lohit said, the topic for discussion today is achieving financial goals. Using SIP as a route, which mutual funds typically offer. So I have a small presentation for that purpose. Post which we'll open up the floor for a Q&A. Uh, Right. Lohit, just a confirmation would help from your side. If you can see my screen, just let me know if it's visible.
It is visible, Nirbhay, now.
Lohit,
Yes. Yes,
can
it's
you see?
visible, Nirbhay.
All right. Okay. So,
Yeah,
I think, like we mentioned, right, we are going to talk about achieving financial goals through mutual funds, and of
that's
course,
correct.
we are going to have our emphasis on SIP also, because that is, I think, one crucial element which our investors can leverage on. Because it's a facility ultimately which helps in a multiple of factors which I will touch upon. And so let's just
Yeah.
deep dive into the presentation. So why do you think you should invest, or why do you think you should keep aside some money from whatever source of income you have? The basic idea is, or the first thing which comes to mind, is saving for a rainy day, right? That's what we've been told as we've been growing up, and I think that's a very important
Mhm.
life lesson which I think is usually not a part of many books. Or financial education is something which is not a part of many books in our education system, but I think that comes to us inherently from the fact that we as a society have a lot of emphasis on saving for a rainy day and ensuring that we face crises, or we face adversity also with enough in the bank.
That's correct.
Another thing which comes to mind is that when we actually make a lot of money, or when we start doing XYZ, money is of course the variable or an output which comes along with it, but we need money and we make money in order to fulfill all the dreams that we have, right? Ultimately, whether you're in business, whether you're in a salaried this, or whether you're doing anything else, ultimately you all have goals or dreams that you want to achieve. And to the fact of the matter still remains that goals require a lot of money, be it as simple as buying a car, or a near term goal like having a foreign holiday, or a longer term dream like investing in your child's education, buying your own house. And the most important fact is that people often overlook is your retirement. While people place a lot of importance on the things that I just mentioned about, uh, uh, you know there is a proven analysis which has that out of the total available set that you have, hardly 5 to 7% of the people who have a steady source of income think about their retirement. Post retirement, what is it that is needed in order to survive or to maintain the kind of life that we have today? So again, retirement is something which people miss out on very easily, and I think that is a great learning for everybody here today, that while we have short term goals, financial freedom purely comes from the fact that what is it that you have post retirement, and how well you are able to maintain your the quality of life that you have currently. So this is a simple slide which tells you, we've all heard about the cost of money only decreasing over a period of time. Why is
Mhm.
that? Right? You've always seen that inflation eats up into whatever you make. So the hot topic of discussion in today's time is what is flashing in every newspaper, is what is there on every business news channel, is the fact that inflation is again picking up pace, be it
That's
India
correct.
or be it abroad, right? We've seen that the cost of money doesn't remain the same, and with inflation on the rise, the ability for your 100 rupees to buy you the same stuff 2 years down the line or 3 years down the line is not the same. People often, while doing their financial planning or their goal planning, tend to miss out on this. They think that अरे आज 5 लाख में हॉलिडे हो रहा है, 3 साल बाद भी हमको 5 लाख ही चाहिए होगा. Well,
Mhm.
if reality hits in, that's not the case, right? That 5 lakh that you need today is not 5 anymore. It will be definitely 5.2 or 5.3, depending on what is the rate of inflation prevailing in your country. So this slide is just to give you an example of what is the cost today and what will it be 10 years later. It's a simple mathematical equation where you just multiply the cost today with the rate of inflation and raise it by the number of years that you have to achieve your goal. That should be a good starting point to tell you what is it, or what is, or how much is the money that you need after that point in time to achieve that goal. So
I agree, Nirbhay, because when we did our management and now what is the cost of a management is is like
absolutely,
the cost
exactly.
when kids are going to do management and when we did management was a lot of difference, today.
I
That's
completely agree. So I'll even get down, forget management. Management is still a big example, right? I'll talk
uh,
about something which is very dear to my heart, which is South Indian food. I remember
correct,
in my growing up days, a plate of idli used to cost me not more than 20-25 bucks, right?
right,
Today, even if I go to a normal, not even a fine dining restaurant, that cost is at 80-85. So over a
correct.
20-25 year period, it has become four times. So that is nothing but the cost of inflation reducing your value of money. It's as simple as
I
that.
agree. I agree.
So that is what, when we speak to investors, this is something that we completely highlight, that please don't factor, or please don't miss out factoring in the cost of inflation, which will be the most important determinant when you actually want to achieve your goal. You might fall desperately short if you don't factor in inflation. And also, like I mentioned earlier, right, many a times people forget that they have a limited time span to work. Like, they might think that I will work till 60 and post which I will retire, but they often forget that post 60 there will be no steady source of income which is available today. So how do you spend the next 20-25 years of your life, assuming you have a lifespan of 85? How do you maintain your lifestyle for the next 25 years? Because number one, you don't have a steady source of income, and number two, inflation is always going to hit you. So it is
That's
very important. Forget, so like we always keep saying at Axis, that true financial freedom is only achieved when you actually plan for your retirement. Because post that, all these goals which you have, which we already saw on screen, are achievable when you're in your working life. Be it
that.
taking a trip, buying a car, that can definitely be financed by your salary income, or as you grow in life. But once you stop earning, or once you stop having a steady flow of income, that is completely taken away. So please bear in mind that retirement planning is one of the most important aspects of financial freedom, and can only be achieved with proper planning at an early stage in life. Many a times we see people making the mistake of planning for retirement when they start approaching their 50s, which is
Right.
absolutely the incorrect way to look at it, because the time for you to retire is fairly less, right? The number of years are either 10, 12, depending on when you start. So it would make sense, just like how you plan for your long term goals, to plan for retirement in the same way, because not only is retirement a long way away, but also the years that you have after retirement are pretty long,
That's
right? So
true.
the amount of planning that you need is far higher than planning for a simple goal, like, or a short term goal like buying a car or taking a foreign holiday, right? So this is something that we just discussed about. An important point in the imagery is the center of the image, whether you want to make it a burden or whether you want to make it an enjoyment, right? Goals are always going to be around you, be it education, marriage, holiday, retirement. It's up to you whether you want to perceive yourself carrying that burden, or you want to have a big sack of money on your back and enjoy whatever life throws at you.
That's true.
Right. So the next slide that we come to is, how do you achieve these goals? There are two simple words which are written on the screen, and I think Lohit, you mentioned this somewhat in the brief part that you spoke about, right? Where you spoke about offering
Yeah,
saving products and you spoke about investment products. While
that's
it
true.
is it is completely different in the way that they represent each particular word. The fact of the matter is that people in not only India, but generally most of the economies abroad also tend to mistaken savings for investment, right? Savings is, in
Right.
simple words, just keeping aside money while not putting the money to work, right? If, like the image
That's
says, you're putting aside 500 rupees in a pot or a box which is like your kitty bag, but it's honestly not yielding you any
yeah.
results because you've put that money to dead use. But on the right, you
That's
see an imagery which talks about investing, right? That same 500, if you put it in the first jar, over a period of time, depending
mm,
on which asset class you pick, right, it can come out to be the image that you want. So if you're a very aggressive equity investor, and if you have a suitable time period of 10-15 years, the output can be significantly greener than what you desire. So there is a big difference, between savings and investments. And I think we also keep urging our investors that, every time you get an opportunity to keep aside something, please don't save, invest that money. It can be in an
That's
asset
correct.
class of your choice, but please put the money to use. It's ultimately money will make more money for you. That's the common saying in life.
Yeah, you
So
can invest
I
in
think
as per the risk appetite. You can invest in as per
exactly,
the risk appetite you invest in, but
exactly.
once you must invest, aside a part of the salary or part of the income what you're getting into,
Yeah.
one must save, one must invest.
I
That's what.
agree. So again, I think asset allocation plays a big role. You don't want to be overly exposed to one particular asset class also. So I think this constant investment habit also ensures that your asset allocation stays the way you want. So if one asset class is, significantly doing well, you might as well want to reallocate it to, another asset class if valuations go out of whack. So of course that is all very technical. We'll keep it for another session. But the basic idea is what our investors should be focusing on is, please put the money to good use. That is how you will ultimately achieve your goals, and that is how you will ultimately go on to achieving financial freedom, right? So we have an investment landscape which I'm sure, Lohit, you keep on covering a lot with, your investors as well, where, right from a fixed deposit in India which used to pay, as high as 10-12% about a couple of decades back, to where we are at
Right.
about 5 and 6% today, right? The range of investment products which is available in India is must say is fairly good. But my disappointment is only with the fact that money has not been channelized to the correct asset class. Because
That's true.
like the next slide, which, which tells you about asset class returns and also the post inflation returns, right? This is what we've been talking about for the past, 10-15 minutes. Inflation is that only big variable which you tend to forget, when you're ultimately planning your goals. Post inflation, right? If you see the returns, right, 4 out of 6 have either been negative or flattish, which honestly doesn't do you any good because you're technically not making any money. So if you save 100
That's
rupees today, it will be only 100 after 5 years after inflation. So while you're managing to beat inflation, you're not
right.
managing to make the real money in life. So right, so this is where we talk about investing in the right asset class also. So depending on the risk appetite, like I think you mentioned earlier, equities and mutual funds, you can see a huge dispersion in mutual fund returns. That is because they offer a wide variety, right from liquid and overnight to as high, as an equity product which is either a small cap or a thematic. So hence the level of dispersion in returns will also be significantly higher. Whereas if you see, post inflation returns for fixed deposits, PPF, real estate, gold, while we've always heard about gold being a hedge against inflation, it's only an hedge. It will not help you make that incremental return. So it is very important to have a right mix of asset class in your portfolio, right, in order to achieve those goals that you're looking for. And of course, that asset allocation has to be in line with your number one, your risk appetite, and number two, the time frame of investment horizon that you have. You cannot tell me that, in 3 years you want to, double your money, but at the same time you want to have a debt investment. It doesn't work that way, right? So if your return profile is also very aggressive, then you have to take that risk also. So subsequently it works on the other side also. So in a investor's portfolio, we believe that, in order to achieve short term as well as long term goals, a mix of all asset classes is something that, we always recommend, and asset allocation is something that, we talk about a lot.
Right.
So I'll skip this slide because it's with direct equity investments. Right, we'll
Understand.
come to the topic of discussion with which is, how do you achieve that through mutual funds, right? uh, like we are here on call to talk about, how mutual funds can be an important cog in the wheel when you actually want to achieve your financial goals. So in simple
Yeah, it
words,
can be a vehicle. It can be a vehicle to, achieve your goals as,
exactly.
what you have thought about as a milestones.
Yes, because what happens, Lohit, is, many a times we do have the money to invest, but we don't have the expertise. And what might happen
That's
in
correct.
that case is you might actually end up losing money rather than, saving for your better future. So I think sometimes it's better to leave, these things to experts. It's better to leave, decision making in the hands of people who are in the thick of it, rather than sitting away at a 30,000 feet view and trying to take a wild guess about betting on your future. It's almost like betting on your future without being sure of what you're doing. So I think this is the main reason why, honestly, mutual funds over the last decade have prospered in India. I remember back in 2013 when total AUM was about 6 lakh 7 lakh crores. Today it is at about 38 lakh crores. So the kind of growth that we've seen is completely exponential, because people have become aware that experiences when they've tried doing it yourself is very different when they've given money to a professional money manager. And these are very easily accessible tools today. I'm sure Bajaj Markets also is empaneled with a variety of mutual fund houses. So the option
Yeah,
which
yeah.
the investor has at its disposal is tremendous. All they need to
Yes,
do is being guided by people like you to ultimately achieve select the right products which can ultimately help them achieve their goals, right?
that's right.
So that is the job of the mutual fund. So if, for the sake of our audience, if I have to simply explain what mutual funds do, it invests in different asset classes, but at most point in times it works on the method of pooling, which means it will collect money from people like you, me, a third party, a fourth party, a ton of investors, bunch that money together and invest in securities which have a common goal. So say for example, me and Lohit want to invest in an equity fund, right? So Lohit will contribute an XYZ amount, I will contribute an XYZ amount, and together that fund manager will buy or invest in securities which the fund has prescribed for. So if it's an equity fund, the fund manager will go and buy an equity scheme. If it's a fixed income fund, the fund manager will go and buy debt instruments, based on the objective which the fund is there to achieve. And this
Right.
is passed back to the investors in the form of growth, in the form of return that you see in the form of an NAV growth. There is also a dividend option which is available to investors. So investors who are looking for consistent or regular income in the form of dividends can also subscribe to a dividend option. But most often than not, if it's an equity scheme, investors tend to go for the growth option. So that is how
Yeah.
typically a mutual fund would work. Also, just to throw light on what are the types of mutual funds, just to put it simply in broad categories. Of course, these will have a lot of subcategories also, but an equity fund or an equity mutual fund is a mutual fund which will invest in stocks. A debt mutual fund will invest in fixed income securities, and hybrid is a mix of both. I will not get
Yeah.
into the details of the each of the categories because there are about 19-20 of them, and I think we require a separate session for that. But just to give you a broad perspective of how the risk profile will play out, debt will of course have the lowest risk in terms of an x-axis and a y-axis, but on the return scale also it will be significantly lower because the risk is lower. Hybrid is of course a mix of both, and hence it will fall between debt and equity. And equity will of course fall on the right hand side if you plot it on an x-axis and a y-axis, because while the risk is higher, the return potential is also significantly higher. So these are the broad categories of or types of mutual funds that are available in the market for our investors. But now that you've known about mutual funds, how do you invest in them? Well, there are two methods. One is a lump sum method and one is a SIP method. I will of course just give you a brief on what the advantages of both are. Lump sum, like the word suggests, it is you have a certain amount of money at your disposal, and if you directly want to invest at one shot, that is what lump sum is. SIP means a systematic investment plan, and like the abbreviation says, it invests your money systematically on based on the time frequency that you have selected. So the diagram that you see, right, the picture that you see on the top, an SIP typically helps you negate the ups and downs. While you can use SIPs for all the funds that are available with a particular mutual fund. An SIP is typically used for investments in equity products, because of course you have a lot of volatility which is associated with equity markets, like you see currently, right? We are witnessing a correction in prices for a variety of reasons,
Yes.
which we will talk about maybe in the Q&A session with Lohit. But with
Yeah.
you can see that, in order to get through the market volatility and ultimately have a view towards achieving your long-term goals, an SIP is the most obvious choice, and a kind of a no-brainer trade for investors who are not worried about near-term volatility, and while at the same time want to keep participating in equity markets. I think it's an excellent way to take advantage of the price correction which is happening in the market, while at the same time you can argue that if I have a lump sum investment or a lump sum corpus with me, can I do at one shot? You can, but of course then you're restricting yourself to take advantage of any future price correction which happens. So investors who are well aware of how the mechanics of an equity market or capital markets work can depend basis their preference. So but ideally for retail investors, and for people who are salaried, an SIP I think is the best form of investment, because it ultimately is light on the pocket, as well as helps you achieve the market volatility question. So just to again, just I have a slide on what is an SIP. I know it might be pretty basic, but again for audiences which might not have an idea, just to give you an idea, it is similar to what a recurring deposit is, right? Our parents, our grandparents have been doing this for I think a number of years now, where every month they would go to the bank and have any cash flow that they receive deposit in the bank and make a recurring deposit out of it. So in that way, an
Daily
SIP.
passbook update. That's what
Exactly.
happens.
I agree. I've seen that passbook to myself. So every month you would see a new deposit getting created. And of course, on maturity, it is either auto renewed or it is paid back to the investor. So I think the concept of SIP is very, very similar to that of an RD, where on a monthly basis, basis the mandate that you've given the fund house, your bank account will be debited and units will be allotted to you basis the NAV that is prevailing in the scheme. So it's a fantastic tool for investors who are new to the market, investors who have steady cash flows and are definitely wanting to achieve their goals over a period of time. So if I say have a 5-year short term goal, and let me just give you an example of buying a car. I can start today depending on the returns that I'm expecting and the money that I'm going to invest, because it has to be a function of both. Like you cannot tell me that I'll do 1,000 rupee SIP for 1 year and I want 5 lakh rupees out of it. That practically is kind of impossible. So of course there has to be alignment with the amount that you're investing and the return that you're expecting, because ultimately do understand that an SIP is a tool which helps you achieve your long term goals, right? It's something to do with a goal which is 5 year plus. So it can be buying a car, taking a foreign holiday, your child's marriage, your retirement. So that is where an SIP actually comes in, because in the initial years, while you're contributing a small amount every month, the kitty is still very small. So the compounding effect is actually going to kick in only when you have a substantial corpus to play with. And hence we believe that this is ideal for investors who are committed towards achieving their goal. They're long term in nature, and they're very confident about negating the other things which come along with it. Just to give you some advantages, right? I think we've covered briefly some of them, but just for the purpose of our audience, just to highlight some key ones. Light on the pocket, because all fund houses today have a facility where an SIP can be as low as 500 rupees on a monthly basis, which is actually a brilliant way to get even people who don't have a high earning income capacity to at least plan for a better future, right? Not everybody will be able to do SIPs which are 5,000, 10,000 in nature, but I think it's a first step. It's a step in the right direction, and I think ultimately it can cover a much wider investor base given the dynamics of our economy. Right, financial discipline. Once you start this process, your parents can tell you or your grandparents can tell you, even with an RD, it's a matter of discipline, right? You go to the bank every month, you do the process, you get your passbooks updated, and there is a sense of satisfaction once you do that. Similar is the
Yeah.
case with SIP, right? It imbibes the principle of following basic discipline in life, because you're not perturbed with whatever is happening in the asset class that you're invested in. That's the biggest learning, or that's the biggest advantage that SIP brings in. It makes you disciplined in life towards achieving your goal, for the long term. Imagine picking the option of doing a lump sum investment, right? This is one place where I feel that SIP scores significantly is they remove the bias.
Yeah,
Imagine that you have a lump sum corpus lying with you. The market has corrected today, but now that greed kind of sets in because you feel markets will correct more. But honestly, you can be very wrong and the market can reverse from here. So, and again you'll be left with money in the bank and you'll not be putting your money to good use. But if you had followed the SIP process over the past 6 months, every time the market has corrected, you've bought units at a much lower level. And in that way you are much more invested compared to somebody who's doing a lump sum investment. So that is something which is of crucial importance. If you have to achieve your long term goals, you have to allocate money over a period of time in order to see long term wealth being created and your goals being met, right? Power of compounding, right? It's there is a phrase which I think most of us in the financial markets are used to, which talks about the fact that the power of compounding is actually the eighth wonder of the world. And it's actually true. People actually don't realize the importance of compounding over a period of time and the magic that it can do to your overall investment kitty. I'm sure there are tons of examples, Lohit, available with you, where you have a lot of funds which are, available for the past 15, 20 years in the market at a 12% compounding. An investor with a 1000 rupee SIP has kind of accumulated amount which runs into lakhs. I'm sure you can share that with our audience because that is
that's
the
correct.
true power and magic of compounding. So many a
Yeah,
times investors
that's
don't
right. So
realize.
even we have few, yeah. So we have few employees who have started their work, and they started to invest once they started their new job, and
Yeah.
with 1,000 rupees today for about 10 years, and they've grown the money multiple times because of that. That's
Absolutely. And I think
yeah,
what we often fail to also overlook is that 1,000 rupees on a monthly basis for 10 years by itself is a lot of money. Forget
that's
the
true.
growth, forget the growth that you get on it. Even if I put that money aside, it's a lot of money, right? So I think it always helps, like I said earlier, also to meet a rainy day. And I think the fact that compounding is often overlooked can be emphasized by the fact how equity markets have grown. Nobody would have assumed that Sensex in 1989, when it was at 100, would grow to about 60,000 in 2021, right?
That's
That's a massive compounding effect which plays in, because every time you miss a rally, you're actually missing out on that leg of growth, right? While of course
and
markets will
that's a
keep.
fact. Yeah, and Nirbhay, that's a fact which is visible today to everyone in the market.
Correct. Correct.
Yeah.
Exactly. So I think so. Of course, markets will keep moving higher, but it's the stage at which you enter will have the compounding effect, right? If somebody invests at 100 rupees and sees 200 rupees in a portfolio, for him to go to 400 is only a 100% jump, but somebody starting today has to do 4 times. So basically, the multiples just keep changing the moment you keep delaying your entry to the world of financial freedom via various goals. And also, last but not the
Yes.
least, the most important fact is that, like I just touched upon earlier, is the fact that you get a benefit of rupee cost averaging. Don't go by the jargon.
Yeah.
Simple terms, it means that whenever markets fall, you get more bang for the buck. So if you are investing in a falling market, your SIPs will yield you a lot of more units compared to a rising market, and hence we believe it is important to invest throughout a complete cycle and take advantage when markets fall. So anybody whose SIP gets hit today will get much more units for the SIP amount that we have compared to say 2 months back when markets were at much higher levels compared to where they are today. So it's the simple thing of talking about the fact that whenever markets are falling, please use that as an advantage to add more to your portfolio, because the impact of this is ultimately seen 5 years or 10 years later. You might not actually realize it today, but units bought today hold much more value as and when markets go higher. So hence very important to keep in mind the rupee cost factor as well. When should you start? I think the answer is not on screen, but I think when they say when is it a good time to start an SIP, the answer is always, right. And it's never a
It's a
it's
nice,
never
it's a nice way to represent Nirbhay. I must compliment. That's all. No?
Thank you
Yeah.
so much, Lohit. But
Yeah.
the fact remains that it's always a good time to start an SIP. It's like whenever you ask yourself you want to have a coffee, you never say no, right? Similar is the case with investing. What is the right time to start? I think it's always the best time to start, because I think markets will keep evolving. Situations will be different, conditions will be different. But the fact remains is that the sooner you start, the more advantageous it is, because you get that maximum number of years to capitalize. Number one, not only on the compounding effect, but also to contribute more, right? So the more you contribute, the more the number of years you give, the better it is for you. And I think, Lohit, you
That's
know that most famous saying in the market, it's not timing the market, but time in the market, which is more important. So
that's
I think
true.
similarly, that holds true for SIPs also. The more time you give it, the more consistent you are. Look at the difference in corpus, right? I think it's an excellent way to tell somebody to start early, because it's almost three times to what they've done over their lifespan. So, and with an investment which is as small as 5,000 rupees. So I think a very clear depiction that Mr. Early Starter is definitely going to laugh all the way to the bank. And just to wrap it up, if investors are not sure about how much money they need over a period of time, I think this is something which had become very, very popular in between, is to how to become a crorepati, because I think that's an aspiration which I think most of us have, right? It's a tag which is nice on the social CV, but at the same time gives you a lot of flexibility in terms of doing what you want with your goals, right? You can plan a holiday, you can get your child married, you can make him study at a good education, at a good institute. Ultimately everything comes with money, and hence the aspiration to be a crorepati is something which most of us aspire for. So what this simply tells you, and I'm sure with this is available with you guys also, either at your app
Yes.
or in person in Excel, where you basically plot the number of years that you have for investment, and your expected return, which should ideally be more realistic, and what is that amount that you need to save today in order to become a crorepati after this. So if I have to simply take one example on this chart, say if my investment horizon is 15 years, and if I'm expecting a 10% return from my investment, I basically need 24,899 as my monthly SIP in order to become a crorepati after 15 years. Mind you, this is also factoring in the fact that your money will grow at 10%, and also there is an
That's
inflation effect which will kick in. So I think in order to become a crorepati, this is what you need to save. Similarly, you can plot your number of years and your return expectation in order to achieve at how much money you need.
right.
Again, the wealth creation formula, which is the most important to achieving all your financial goals, I think the saying is pretty much here: compounding interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it, right? So people who block out money early from compounding asset classes like equities are the ones who ultimately pay for it, because they don't achieve their goals, and they have to go for that incremental difference somewhere else. But somebody who stays invested reaps the benefit of this magical formula, and ultimately is one step closer to the journey of financial freedom,
That's
right? So that's it, Lohit, from my side. I'll be more than happy to take questions
yeah.
from your side.
No, thank you so much. In fact, I believe a lot of investors of ours will start to invest now,
Yeah.
and will become Mr. Early out of this presentation
Yeah,
now. No,
absolutely.
that's
And
what
achieve
we
their
want.
part of wealth creation and financial freedom. Yeah.
Yes. So while we were discussing, Nirbhay, I have few questions which we thought we'll ask you, so that from the investor perspective, I'm sure they must be eager to ask these kind of questions to you,
Yeah, yeah,
so that
please.
that gives them more clarity to achieve their goals through mutual funds. So one
Please.
is that what are the various different categories of mutual funds available, and how could investor choose appropriate category is what we want to understand.
Sure. I think I touched upon it a bit in my presentation where I briefly highlighted there are equity funds, debt funds, hybrid funds. So of course there are subcategories as well. So SEBI in its regulations has clearly laid down what each fund is supposed to do in terms of asset allocation, allocation towards a particular asset class.
Yeah.
So I'll leave it at that. So depending on what an investor is looking for, they can pick either one. And of course, you guys are better placed to guide them towards picking one. But the second part of the question, which is what is it that they need to look for? I
Mm-hmm.
think the number one variable or the number one criteria is to ensure that investors invest purely basis their risk profile, because we've realized that is where the mismatch or the heartburn is. Investors come to a fixed income product expecting double digit returns, and then are disappointed. And sometimes they pick an equity product with the timing is not right. So and then aggressive returns are expected and it doesn't work out. So I think the
Mm-hmm.
most important fact that an investor has to keep in mind before you know uh, committing to one particular fund is the fact that the risk profile has to be in line with the asset allocation that the fund is undertaking, and the return expectations have to be more or less realistically aligned to what the fund has delivered. Of course mutual funds don't guarantee you returns, but the fact is that the past returns can be used as a trend or an indication to see what the fund has kind of done over the over time period. So I
Of
think if
course.
that is aligned, then I think picking a category is kind of a subset, because that will ultimately it's like a funnel. If you're very sure about your risk profile, if you're very sure about your asset allocation, then I think you automatically know whether you fall in an equity fund, whether you want an equity a hybrid fund or a fixed income fund. So I think that can make life easier for investors.
I agree. I agree. Okay. So the second one is Nirbhay, how frequently should an investor review his investment portfolio? And then a lot of
Yeah.
times we see investors, they keep on coming every day and looking for a
Yeah.
portfolio review. I'm sure you will be a better person for us to guide on this on that way.
So I think I'll again use a saying that Rome was not built in a day. Similarly, I think
Yeah.
wealth creation as well as your mutual fund, portfolio will not be built by checking NAVs every day. I think this will only cause a lot of anxiety and sometimes a lot of heartburn. I think what we've seen basis experience, an ideal time is maybe once in 6 months or once in a year, depending on how aggressively your portfolio is placed. So of course, if you have an equity oriented or an equity heavy portfolio, you typically want to do it once in 6 months just to
Mhm.
ensure whether you're right in the cycle. If you want to actually top up your investments, because times like these you might actually want to review it to see if you want to top it up, because like I said earlier, it gives you the benefit of rupee cost averaging, and no better time than to add to your portfolio during a market correction. It's a proven fact that equities only move higher, climb the wall of worry over the long term. So this time also it's not going to be any different. 2 years later this will seem like a missed opportunity if you don't participate. So for investors, having an equity heavy portfolio once in 6 months I think is ideal. For investors having a fixed income, a hybrid kind of a portfolio, I think an annual review is kind of more than enough to ensure that their goals are on track, and whether they want to take any course correction action basis what they're witnessing. So
I agree. I agree. I agree. Thanks. And considering the current market situation today, if you
yeah,
look at Ukraine war, liquidity crunch,
yeah,
repo rates going up,
yeah.
what do you suggest and advise investors on this?
So again, I think this will boil down to the first question that we discussed, right? The asset allocation that an investor has and the risk profile. It wouldn't, be apt if I recommend, taking aggressive exposure to equity to an investor who has a fixed income bias, right? So number one, what we have to sort out is the fact that the asset allocation is correct and the risk profile is correct. But given the fact that we are if I do have to give you a recommendation, of course for equities you definitely top up your SIPs and look at places of safety like large caps, because I think the next 6 to 8 months kind of look a bit uncertain given with the rise in interest rates. And on the fixed income side, of course, with rates on an upward trajectory, something like a short term product is ideal for investors who want to keep repricing their investments over a point in time. So I think in terms of guidance, I think on equities you should look at probably a large cap kind of an allocation, and in terms of fixed income, more of a short duration kind of an exposure. So
Okay, got it. And in terms of bank deposits contribution to the household asset, if you look
yeah.
at, do you think it's increasing, and how what's the trend like in terms of that?
That's actually a very nice question, because I think the kind of growth which mutual funds have seen, somewhere an asset class like bank deposits have been the most hurt, while they still remain, as a percentage of our investable, deposits at about, I think if I'm not wrong, 65, 66%. I think that was the
That's
number
true.
in
That's I think the
2020.
right number we also gone through.
Exactly. So I think that's a lot of money which is parked in, asset classes which are not going to even yield you inflation-like returns. So if I'm not wrong, I think a one-year FD is today yielding 5.5%, where your last inflation print is 7%. So
Yeah,
technically, 1.5% is going from your pocket. You're not even making enough money to cover for the cost of inflation. So I think for mutual funds, that's a significant, opportunity to move that money. As awareness goes up, I think people will realize that, that investment is not bearing fruit, and hence, an opportunity, a very large opportunity is at play for mutual funds, is what I believe. So
right, right. Last, Nirbhay, will not take much of
yeah,
your time. I know you've been speaking quite a long time now, about 25, 30 minutes. So, what are the advantage of investing into SIP over lump sum is what you have already mentioned during your
yeah.
presentation, during our discussion. Final note to the investors so that,
Final
they
note
take
to the
that
invest. Yeah, I think then I think if it's, see, it's always a choice between what suits you in terms of your cash flow, right? I think for somebody whose cash flow is, pretty lumpy, I don't think so they have too much of a choice, right? Because they don't have a steady cash flow, because an SIP requires a monthly commitment from your side. So I think it all depends on the stream of income that you have. But again, if I have to pick an SIP or a lump sum, I would definitely have my bias towards an SIP, purely because of the fact that, it takes away the bias of timing the market. Like I think during the course of my presentation, like I told you that, whenever there is a lump sum involved, the greed comes in, thinking that there'll be lower levels coming, but
Right,
honestly it never comes, and you practically miss that journey, when the markets reverse. So, and you're
right,
again, left with money in the bank, and again investment in products which are not going to yield you inflation type returns as well. So I think my bias is more towards SIP, purely because it, inculcates a habit of, disciplined investing. It tells you that irrespective of whatever is happening in the market, you need to save for the long term, and you need to be rest assured that, markets will climb the wall of worry, and ultimately, you'll be on the path of, financial freedom. So I think
right.
if I have to do, if you put a gun to my head and ask me to pick, I think I'll definitely pick an SIP over a lump sum. So
I'm with you. I'm with you on this. So, yeah, Nirbhay, though, with this, I think we have got a lot of information from you, and uh, now I believe our investors will be able to invest on
yep,
through mutual funds. On our app as well on Bajaj Markets, wherein we
yep,
offer direct funds. That is going to leverage investors as well on that piece to get more
absolutely.
business, more income, I believe, and more yield and a better
Correct.
yield. That's what
I
is going to
agree.
be
I
right.
agree.
Yeah. So we conclude this session, and thanks so much, Nirbhay, for sparing time. And
Thank you so much for
we'll
having me.
like to
Thank
have,
you for inviting us.
yeah, we'll like to conduct more sessions like this with you and with Axis Mutual Funds. That's what.
Always at your disposal, sir. Thank you so much. Thank you.
Thanks so much.
Bye bye.